Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Well, as much as I would like to bring a different story, the story remains the same. The longer tenor yields continue to rise, hitting new cycle highs. The 30-year US Treasury yields is at 4.96%, nearing the 5% mark. What's interesting is the rise in longer tenor yields for other countries like EU, UK, and Australia as well. JK, we have previously discussed the US based factors for these rise in yields, but are longer tenor yields of other countries also reaching an inflection point?
Uh, Good morning, Swaraj. Yes, not necessarily. I think that the reason behind this is that US is growing much better than other countries. And just to give you a perspective, Europe is expected to grow at 0.7% this year, while US is expected to grow around 2.1%. So that makes all the difference. And the fact is that Europe and many other countries are almost at the peak, while in the US, at least going by what Fed members are saying, another rate hike is possible. So higher for longer is more, uh, you know, more a factor in the US than other countries, and that's the reason why the term premium is increasing. That said, while the story has been there for quite some time, the reversal or any stoppage of this unabated rally in the yields can only stop when it starts to hit the system. And I think we are very close to a level where the system can be already hurting, or it may be already hurting, but it's nothing is out in the open. So we just have to be very cautious and what comes out, in the markets, because remember what happened in September last year when the yields went up in UK, and UK also has huge budget deficit, and the US budget deficit, fiscal deficit is well known to be high, and so funding themselves at these high rates can be very hurting for the government. So either it has to increase the taxes, or we may have to see some other type of intervention to arrest the yield. So that's where we are. But overall, yesterday's moves was also given some impetus by the JOLTS data, which came very strong on the headline. But eventually people did realize that the details are not actually so strong. If you look at the new hire, it fell from 5.94 million to 5.73 million. The openings are also seen in the context of the large fall that we have seen in the last 3 months. So it is just a jump in the openings after falling for 3 months, and in fact many don't want to read too much into the number, as it is based on a small sample, and a lot of noise is seen due to subsequent revisions also. And we have other measures of employment in the US which have shown quite a slowdown. For instance, the average NFP number is now closer to 150,000 jobs added in the last 3 months, and this is way less than the Q1 rate of 312,000. So nothing too much to be read. But in the current mood of the market, where they are keen to sell bonds on any news, that did not really impact. Now we have another indicator on ADP private jobs report today, and that is also expected to show a decline from 1,77,000 to 1,53,000. Now, as investors are convinced more about the higher for longer rates, this is, and more some corporate negative news, and more importantly, technical breaks on S&P 500 through 50-week moving average had depressing impact on the US stocks. And what we have seen is more than 1.25% fall in all the three major indices in the US. Nothing to do with the economic data, but it's all the yields, and also the possible corporate stress because of the higher financing costs going forward. No, even the global stocks were down. In Asia, stocks indices, the composite index of Asian stocks are down to 10-month low. Japanese stock market, which had been an outperformer in the earlier part of the year, is now down more than 5% in the last three trading days. Investors have been bullish on stocks this year based on economic reliance of the US. But as they see, the very same factor is now leading to central bank remaining more hawkish for much longer and financial conditions tightening due to higher, longer term yields rising. They are seen liquidating the stocks. There is also some concern about the upcoming quarterly earnings report. Now, come to the crucial part of our update on the currencies. Yen took the center stage in the US hours with a rumored intervention from authorities, but it had actually no confirmation. But when asked about a comment from one of the diplomats, he said he said there was no comment on the intervention. So he actually did not deny also. So most people conclude that there must have been a rate check as the dollar yen went above the crucial 150 mark. And, the move was staggering because from 150.12 to 147.30 happened in perhaps a couple of minutes. And that does smack of some sort of action from the central bank, if not a direct intervention. So although it has bounced back above 149, it stays there very tentatively. And I think people will be on the lookout for central bank action in the coming sessions, or at least a psychological fear has been put into the market. Therefore, the move higher in the yen may be somewhat subdued. In this overwhelmingly bullish dollar environment, both euro and GBP made fresh cycle lows, as well as the dollar index that made a fresh high of 107.34. However, we are not only in the crucial support zones for several major currencies, but further rise in the yields, more to do with the speed of the move rather than the direction, could lead to some systemic risks, as many funds are positioning, looking at the funds positioning of many funds. But the strong trend showing no change, we might well see some extension of these moves in the currencies. But as I said, we are in a very crucial support zone for instance, euro between 1.03 and 1.05, and sterling near psychological level of 1.20, yen at 150. These are levels where there will be no confidence to sell them big time, but there can be short-term extensions of these moves and maybe unsustainable. But we still have no change in the trend, so we would not advise any buying of these currencies until we see any real change in the trend. We also had a staggering fall in gold prices, with near 6% fall from the high of last week, with huge long liquidation seen by traders and investors as US yields continue to rise, and the absence of central bank buying of gold, which is the major support, missing. Silver, which is much more volatile, fell as much as 12% during the same period. Again, we are near the crucial support of 1805 for gold, which should broadly hold, keeping in mind the long-term view of fiat currencies' inability to hold value. And we are near to value buy for the yellow metal. Also, gold is at the RSI, the Relative Strength Index, one of the crucial technical indicator, is at 19.7. And this was last seen in 2018. And when the prices hit at 1190 at that time, it ignited a rally of 30% in the gold prices. So we should be cautious about a turnaround, if particularly watching the yield trends also. Finally, coming to the rupee, as it happens often, rupee opened with a gap, discounting the overnight global developments, in fact, global developments over the long weekend, and then traded within a narrow range throughout the session. Attempts to break higher based on various factors and weaknesses in peer currencies were thwarted by the central bank selling in line with their policy of stability, which I believe will need some tweaking sooner or later. Just for a perspective, since September, Korean won has weakened by 3.5%, Rupiah by 2.64%, Thai baht 6%, and the usually stable Taiwanese dollar is also down by 1.8%. Keeping in mind the export performance of our country, we cannot have a very strong currency, and I think this may be a factor that can come into play if the dollar continues to be strong. Of course, we did have some pullback in the crude prices, but still holding above 90. That is one factor that we cannot ignore as well. So till we see the central bank allowing some adjustment in the rupee value, current uninspiring ranges and short-term hedging activity, it should confine to flows and short-term hedging activities. Speaking of flows, after the month of September saw FI flows turn negative, This month has started with fresh outflows, and domestic stocks have shown vulnerability to the global volatility. So we look forward to some change in the rupee's behavior in the coming days, unless the central bank decides to hold the line for much longer. Thank you.
Thank you, Jackie. And of course, the major event yesterday was the JOLTS data. The job opening data yesterday came out stronger when it comes to the headline figures, post which we again saw a rise in yields. And what's interesting is the Japanese yen experienced some rumored intervention around the 150 mark. Which it's a big psychological level. Even euro and GBP, they made fresh cycle lows, but these currencies are again at a crucial support zones. But the trend remains stronger. Gold prices have been falling sharply due to the rise in yields, and even the central banker buying seems to be absent as of now. For rupee, we continue to trade in a narrow range. Central bank actively managing the volatility, but as JK mentioned, it might need some expansion of the range given the peer currency performance. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.